Wednesday, March 7th, 2018, Monaco 64, home of alternative economics and contrarian views. Yes, I think gold is ready to make a big move in the next few months, and the technical target for it is almost at 1500. More exactly 1475. Before I go further and look at that technical formation and why I think it could go there, let's have a look at the markets. It's just after 8 a.m. Yesterday, after the close of the markets, we had a headline of a story that came out in the New York Times saying that Gary Cohn, the chief economic advisor to the Trump administration, was going to resign. He's the ex-COO of Goldman Sachs, of course, and there's been a lot of speculation that he might resign because he's not happy with Trump's policy of tariffs on trade, on foreign trade, of course. And he did resign. The stock market reacted negatively. That's what all the headlines tell us. And the Dow overnight open already down 300, in the futures. We got down as far as down almost 450, down to 24,400. Right now we're at 24,500, down 320 points or 1.3%. S&P is down 1%, down 26 points. The NASDAQ is down 1% as well, or 64 points at 68.47. I personally believe that the reason, we get inflation, we get market, bubbles or market crashes, is all to do with monetary policy. The reason why we get the pound falling and debasement of the currency is all to do with too much debt, central banks creating too much money out of thin air, and, the mainstream and the mainstream media, the mainstream economists, which are subsidized by the powers that be, that control the money system, the central bankers, and the people behind it. They use stories to justify it in order to push the blame somewhere else and not at the fact that the whole problem of bubbles, business cycles, stock market crashes, stock market bubbles is all to do with hot money created out of thin air through a centrally planned, monopolized monetary system. So, yeah, they're going to say that, if we continue going lower in the stock market, which technically it looks like it will, they're going to blame Trump. They're going to blame his, crackdown on world trade with tariffs, just like he blamed the Smoot-Hawley Act during the Great Depression. They never put the spotlight on the central bankers. They don't talk about the fact that we've had 10 years of monetary policy that has been we had never seen before. Zero interest rates, sometimes negative, huge money printing, huge percentage of the GDP being printed out by central banks. They don't talk about that it creates problems in a free market, in an economy that's supposed to run freely. But it doesn't run freely. They're not going to blame, Ben Bernanke, his predecessor, Alan Greenspan, Janet Yellen, or they're not going to blame Eddie George in the UK, Mervyn King, or Mark Carney. They're going to blame Trump. And maybe he's falling for it. Maybe he's doing it for them. Who knows? Maybe Gary Cohn is getting out because he knows everything's everything's going to hit the fan and he's going to be able to make a killing, but he needs to be outside the White House. Maybe Trump is doing these trade policies because he knows things are going to get bad and he needs to, maybe bring some jobs back to the U.S. What I'm trying to say is that don't believe in what they tell you the reason why things are happening. It's like here in the UK, we keep being told that, you know, the reason for higher prices, inflation, the weak pound is all because of a vote on June 2016 to leave the EU. And it's not. I've done you know, videos before looking where the pound was in 2008. 1 pound would buy you, you know, $2.11. That was the high at the time. And then before Brexit, it was 150. And now it's 138, 139. We got down to 120. Brexit only accelerated. And why are we debasing the currency? Well, because as a country, as a government, as individuals, as corporations in the UK, we're heavily indebted. And the only way for the government to carry this debt is to make its currency worth less. That's common sense. That's what they do. They've been doing that since time immemorial, and people need to wake up. So that's what's going on. Yeah, we're going to see, if you watch CNBC or the other mainstream media, or, you know, BBC, CNN, Fox News, all they're going to be talking about is the fact that, you know, this is what caused the Dow to go down overnight. Will we still be there when the U.S. markets open? I don't know. But yeah, they're going to be talking all about Cohn resigning, Trump's, you know, trade policies. They're causing, you know, people are really angry. But it's got nothing to do with it. It's all about the money. You got to put the focus on the central banks. They are the culprits. And the banking system, the fiat money system. So what about gold? Yesterday, gold and silver had a very good day, surprisingly. Without much else happening, you know, we got up to almost 1340 in gold from a low of around just below 1320. Silver outperformed, which is good. This morning, we've seen a little bit of a pullback. Gold is at 1332.50, down 2. The range has been 1341 to 1331. I think we got up to 1341 last night, just after the open on COMEX at, what time is it? It's at 6 p.m. New York. But it's since kind of pulled back a little bit. I think that's probably normal, seeing the move we saw yesterday. Currency-wise, we're seeing it's pretty quiet. Euro is a little firmer. The pound is a bit weaker. But the dollar is down about 0.5% against the yen at 105.66. So let's have a look at the gold chart. I said, you know, gold's going to go to 1,500 almost. I don't usually make these predictions, but I'm just looking at the technicals. And the time frame is difficult to say. It could be a month. You know, it could be 6 weeks or 2 months. It's very hard to say. It will take a little while, and I'll explain to you why I think that will happen. So here we've got this from topstockresearch.com, what they call a bullish pennant. So you get like a move up, you know, the flagpole, and then you consolidate. You make a 1, 2, 3, and then 4, like a zigzag in the triangle. And the price target is the distance of the height of the previous flagpole. You superimpose that on top of the triangle, and you get a target. So that's called a continuation chart, a continuation pattern, and it usually resolves itself to the direction of the previous trend. The previous trend in the bullish pennant is bullish, as you can see, and then you know, it resolved itself by making another bullish move. Yeah, I think the rule of thumb, percentage-wise, is that three quarters of the time it resolves itself in the continuation of pattern. The other times, you know, it turns around. It could go back down. So it's not an exact science, but it's the law of, you know, it's statistics. There's a good probability that it could happen. So that's you know, the technical analysis part of it. You know, this is stuff that I learned I did technical analysis courses when I started out in the 90s. I asked my company, the people I worked for, to do the courses. I remember they used to have a life futures exchange courses, technical analysis. I did that. Life was the London International Financial Futures Exchange. And you also learn from other colleagues at work, people who had more experience, who were more senior. You ask them questions, they're free, they're happy to help. If you ask them nicely, of course. So yesterday I was looking at this chart of gold on barchart.com because we've been focusing, and I think a lot of the other technical analysts, they've been focusing on this kind of bottom that gold is forming the last 4 years, and that we've got this ceiling around 1350, 1375. But the price action the last few weeks in gold and last few months have now evolved to a point where I can see one of these bullish pennants. So you've got there the move up, from the low of 1236 to the high of 1365. That's the bullish, flagpole. And now you've got the bullish pennant forming. You got one, from the 1365, you got a, leg one down to, that low in February. That was around 15, and then you have another leg up to the high there, around 1360 or just above 1350. You can see it's moved up above that the top of the triangle there. I think just because it was a bit of a spike, that's how I drew it. And then we've moved down recently, and we traded down to like 1302 a few days ago. And we closed right on the triangle there, and that's why I put the line like that. It's a little bit like the spike we had before in the previous move up. So what it's telling me now is that we could, of course, consolidate for another few days or another week even, and then, break above the top of that triangle, which is probably right now around just below 1350, like 1345, 1346. And I'll show you another chart here. You see, that gives you a better idea. It doesn't allow me to draw it as a perfect, like a bullish pennant. It's like a trend line, but you can see there the apex of the triangle. So yeah, we could consolidate a little longer, but I think once we break through that top of that triangle, just like that little educational chart that I showed you before about bullish pennants, I've done my calculations. If you take the length of the flagpole and you add that, transpose that to the top of the triangle where it is now at around 1346, you get 1475, which is about $130 move. And as you can see from, the pennant, the flagpole that was formed before this consolidation, that started, beginning of December, and it ended almost in February. So it took almost you could say it took almost 2 months, let's say about 6-7 weeks. So that's the time frame. It's very difficult to predict these things, or it might not happen. We could get to that top of the triangle, we could turn around, and it might not go up there, but it's going to be another interesting day. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet, and you can also follow me on steemit.com and on Twitter. And I'll talk to you later. Bye.